All right, how's it going, everyone? Welcome to another episode of Forward Thinking Investors, where we talk to investors about companies, markets, founders, and how they got into investing. Today, I'm very excited to be talking to Clara Brenner, who's the managing partner at the Urban Innovation Fund. Welcome to the show. How's it going?
It's almost Thanksgiving, so feeling pretty excited.
It is almost Thanksgiving. I'm extremely excited for the war in my family between which pie is better, apple pie or pumpkin pie. I'm on the apple pie side, so we'll
Totally.
see who joins the dark forces.
I share your feelings.
Very nice. Very nice. Well, cool. Well, so you're a venture capitalist, which is awesome. This is a show where, we talk to VCs. And usually the first question that we dive into is everyone has a different path into venture. So what's your path? How did you break into venture capital?
My background is actually in commercial real estate development. After college, that's where I was working. And I went back to business school because I thought I was going to start my own firm in that space. And while I was there, I ended up kind of catching the tech bug and really shared a lot of similar feelings about the space as one of my other classmates, Julie. We'd both been working for, I guess, what we would now call urban innovation companies, although we didn't know it at the time. So Julie was working at a company called Revolution Foods, which is a healthy school meal provider. And I was working at a company called Fundrise, which kind of crowdfunds dollars from the community to invest in baskets of institutional real estate. And this was right around the time that companies like Lyft and Airbnb were just getting off the ground. And we felt like they had a huge amount in common with the places where we'd been working. And so like any good grad students, we embarked on a research study of a space that we started calling urban innovation. So, companies that are using technology to make urban living better. And from there, things kind of took off. We identified a lot of challenges that these companies have in common, most notably a lot of regulatory and political challenges. And when we graduated, we took our research to Blackstone and pitched them on the idea of helping us kind of validate that research and show that there really was an ecosystem of entrepreneurs interested in solving community challenges in cities. And so we did that for 3 years. And many of the companies that came out of our offices, these were really like idea stage companies that we were incubating. They went on to do quite well. And that kind of gave us the credibility to go launch a more traditional institutional venture fund in 2016.
Awesome. I appreciate you sharing that. So let's kind of talk about, because like in your name, you almost have your sector, your market kind of in the name. But let's kind of like walk through what exactly is that urban innovation. What types of, companies are you funding? Are there certain sectors? I guess, how do you kind of define that? And if a founder is listening, like, how do they know if they're kind of in the urban innovation kind of space versus not?
Yeah, I think lately, urban has become a hot topic. And I think most people, when they say they're interested in urban, they really just mean transportation and maybe prop tech. And for us, we have a much more expansive view. For us, we're looking for companies that are tackling the kinds of problems that mayor's offices around the country really prioritize, but haven't necessarily been able to tackle sufficiently on their own. So it definitely includes what you would think of as more traditional smart city sectors. So, transportation, prop tech, utility management, things like that. But we also actively invest in areas like fintech and education and the future of work, since these are all factors that play into, anyone's experience of living in cities. And so we get to see a lot of different types of companies. It's funny, every once in a while we'll get an entrepreneur that says, oh, I don't really understand, what urban is. I don't think we fit. My advice to all entrepreneurs is never say that to an entrepreneur, to an investor. You let an investor decide whether you fit into their thesis or not, because we have such a broad mandate that, we like to look at a real variety of different types of companies.
Yeah, appreciate you sharing that. So you have the Urban Innovation Fund. Walk me through when you started it, a few years back. How did you decide to set it up in regards to stage? Like, are you investing, pre-seed, seed, Series A, or later? And then additionally, how did you kind of think about portfolio construction when you got started? Were you going to write, a few checks into, a bunch of, or into a few big checks into a few companies, a lot of small checks? How do you kind of think about what to do for your portfolio construction for the first fund?
Yeah. So for us, we invest at the pre-seed and seed stage. We're usually one of or the first institutional check in the door for companies. We're writing checks initially of around $750K. We can lead, we follow along, we're pretty flexible there, and just generally looking to be helpful hands-on investors, although we do place a special emphasis on regulatory and political support just because it tends to come up pretty frequently with many of the companies in our portfolio, although it's definitely not a requirement to be part of the portfolio. For Fund One, our Fund One was 25 million. We made 23 investments out of that fund. And for us, I think the balancing act has always been you want to invest in enough companies that you have enough shots on goal, but you also need to control enough of a stake in each company to potentially drive real returns for the fund. So we're on to Fund Two. We haven't announced the size yet, but we're targeting a similar number of companies. It's already bigger than Fund One, which is exciting. And, so we do about 6 or 7 deals a year, which, gives us enough exposure, but also allows us to really build really close and strong relationships with our founders and also allocate enough of our fund for follow-on investing. We don't do follow-on investing in all of our portfolio companies, but we do think it's really important to have the option just because, coming in as that first institutional check in the door means you're really at risk for dilution since there's been this real proliferation of multiple seed rounds. It used to be, you raise a seed round and then you raise a Series A, and now it's, a pre-seed round and then a seed round and then, a pre-Series A or a seed 2. And, if we're that first check in the door, that's a lot of rounds to go through before you get to Series A. And so,
could you try again?
My husband just got me an Apple Watch and I have no idea how to use it. It just set
Nice.
itself
Congrats
off.
on getting the Apple Watch.
Thanks.
That's awesome.
But that's what you just heard, that sound.
No sweat.
But yeah, so for us, we really try to get to know our companies well and, build strong relationships with them, but also make sure we have enough relationships that, some subset of companies will deliver strong returns for the fund.
So if you're writing kind of that many checks throughout the year, that kind of leaves a lot of room for like different types of activities, right? Fundraising for future funds, meeting other investors, meeting founders. But I'm kind of curious for you, how do you break down like an average day for you? If like at the end of the day, like, there's, 8, 9, 10, checks that are being written, there's a lot of time to kind of fill to make sure you're getting into the best deals. What are you doing to fill kind of all that time? And what's your average day as an investor?
It's hectic and it's always different. I mean, fundraising is a major priority. And even when you're not actively raising a fund, you are fundraising, building relationships with new founders, attending events and podcasts like this to kind of continue to evangelize your firm is really important. Connecting with your founders. We do that through both structured check-ins. So on a monthly basis, we try to have a touch point with our founders just to see where we can be helpful and make sure we're on the same page. But also a lot of informal chats. Like we're definitely the kind of investors who get those text messages in the middle of the night on Saturday, and we totally will respond or early in the morning on a Tuesday. I have an 11-week-old baby, which basically means I never sleep. So I'm always around to chat. And that's really important for us. We want to be those types of investors who can be trustworthy partners and where our founders feel like they really can look to us as a reliable support system. And so it's definitely really busy, but it's what we love to do.
So, being, a venture capitalist, there's a few things that a lot of things you're looking at, but mainly like you have like market, right? Which you've kind of already talked about what you like, but then you have, team and like founders, right? What do you look for in like a founding team? And when someone kind of emails you, you get intro to someone, what kind of helps you get to the point where, oh, I'll take a meeting, or, oh, I'll like do due diligence versus some that you might pass on? What's that kind of X factor with those founders?
Well, we look at every deal that comes across our desk, whether it's through social media or a direct email or an intro. We think that has translated to, frankly, a more diverse demographic makeup of our founding team, because we're not just looking for warm intros from other peer investors, although that's something that we do. And so in terms of what we look for, I think teams that work well together are really important, especially for really early stage investing. You're going off of an idea, a plan, but ultimately what you're really backing is a team. And so teams that have had experience working together, teams that, when you meet and talk to them, don't talk over each other. You just seem to have a really strong dynamic. But I think more and more we've started talking about the need for founders who have strong fundraising ability and strong storytelling ability. I think for Fund One, that was less of a priority. And we had a general perspective that, we're comfortable taking on diamonds in the rough. And, our goal is to find a really, solid team with a really fantastic idea, and we can help polish them up over time. But I think what COVID has really exposed is the fact that we need founders who can tell their own story from day one. And that doesn't mean that we can't support some level of polishing for sure. That's part of our job, but there absolutely must be a member of the founding team who can be just an incredibly compelling evangelist for the business. And if you don't have that, it doesn't matter how smart you are. It's a deal breaker for us.
I like to say there's no CEOs before the Series A. There's only chief evangelist officers, because you really you need to talk about it all the time.
All the time.
Because you're the ultimate competitor. I think a lot of startups or founders think, oh, we don't want to talk about our thing because competition. I'm like, no, I think the ultimate competition is just apathy, that no one cares. No one cares
Right.
about what you're doing. So you have to make them care.
For
so
sure.
I think that's a great trait. So what have been, you said you started this fund and your firm in 2016. I'm going to guess you had a little bit of a different experience in 2020 running your fund than you did from 2016 to 2019. Tell me, what is it like being a VC and needing to shift in a COVID era? And have things actually changed that much, or is it still kind of business as usual on your VC activities?
In many ways, it's totally the same. We've backed entrepreneurs that we hadn't met in person before. For example, we've done a lot of meetings over Zoom previously. And so that element wasn't such a shock as I think it's been for many firms. But certainly, I think the idea that everyone has sort of the same subset of companies they're talking to, that you can take so many more meetings now over Zoom, means it almost feels like we're dealing with more pipeline than we ever have before, and more competition because everyone is talking to the same people. And so, that just makes us want to work harder. And ultimately, I think it's perhaps a democratizing sort of feature of COVID, maybe one positive outcome of this generally horrendous time. So that's been really interesting. But yeah, I think by and large, our processes and procedures have remained the same. Our investing priorities have remained the same. It's interesting to hear so many investors come out now and say, we think that the opportunities lie in areas like, education, housing and the built environment, workforce development. These are now hot topics in the investing space that maybe weren't pre-COVID. And these are core interests of ours as a firm. We're looking for technologies that are really touching the lives of everyday people. And it's actually kind of nice to see other investors starting to prioritize those areas too.
It was so interesting. Before I was full-time on Forward Thinking, I was working for a company called Prenda, which is an education-based company in Arizona. And we were kind of one of the first, if not the first, micro school type companies that we started, 3.5 years ago. And it's really interesting to see, as COVID hit, all of a sudden, everyone was into micro schools and everyone was starting a micro school startup. And it was just, I think that's great. That's a great thing, as long as the founders are good and there's good intentions and stuff. But it is interesting just to see how interests kind of waver depending on markets. Actually leads me to another question that I wasn't planning on asking, but it just kind of popped up. There's some founders that, are working in hot markets. Right now there's some hot markets, but there's also markets that may not be hot at all. There might be a founder that just really, really, really cares about somebody in a market, but it's not clear if it could be $1 billion market or not. How do you evaluate these founders working in kind of random markets, but they really are passionate about it and they're very, good at what they're doing?
We love random markets. I think that's where so many of our strongest companies have come. Our goal is not to invest where everyone else is investing, but to invest in founders who are tackling really enormous problems in really large markets. And I'll give you an example that I know is a company near and dear to your heart, a company called Catch. So they're a portable benefits platform. We were their first external investor. We led their pre-seed round. And at the time, people just thought we were nuts backing this company. They essentially offer benefits to any type of worker, but they've had particular traction with gig economy, 1099, freelance type workers who aren't getting any benefits to their jobs. So you can go to the platform and get access to health insurance, life insurance, saving for retirement. The big one for gig economy workers is paid leave. If you're a hairdresser and you haven't been able to work for the last couple of months because of COVID, that's potentially devastating. You haven't been paid for that time. And so they actually have a product that helps you plan for and save for those types of life events. This is an area we've been thinking about for a long time, backing companies in the urban space. We see a lot of companies that are employing gig economy type models, and we recognize a lot of the challenges and problems that come with those types of models. And so when we came across Catch, which had an extremely strong team, great tech, a really compelling product, we just jumped on it. We knew this was something really special. And having seen what's happened in the economy, but also just a larger interest in the future of work, all of a sudden they're like such a hot commodity. They went on to raise a larger seed round that was led by Khosla. They've just grown dramatically. They're now one of the few companies in the country that actually you can shop for your public healthcare option through them. So just it's really cool to see what they've been able to accomplish. But it wasn't like we were investing in this company because anyone literally on earth cared about this topic at the time. And so, we want to find founders who are thinking ahead of the curve, not just following trends. And I think Catch is a great example of that.
Yeah, it's like the framework I use there is like mercenary versus missionary. Like missionaries just work on what they want to work on, and no matter what's going on out there. So there's a lot of founders that are listening to this, and a lot of founders just in general that I'm sure reach out to you that have differing knowledge bases on how venture capital works. They probably have different, knowledge. They may know a lot about you. They may know very little about you, but you're getting all sorts. What is one thing that you wish founders knew more about venture capital in general that they don't, that could potentially better their chances at getting a deal with you or just any VC? That some things that may not usually be obvious to someone, that reaches out to you.
That's such a good question. I mean, this isn't true for all venture capitalists, but it's true for some, and it's definitely true for us. We ourselves, Julie and myself, as the founders of the Urban Innovation Fund, are entrepreneurs ourselves. So we, had to fundraise, sell people on our mission, go without a salary for a long time, market ourselves, manage people, run our business with the hopes of making a big profit. And so I think we have a lot more empathy for the experience of the startups that we meet and startups that we're funding than I think a lot of people realize. We don't see ourselves as different from any of the founders that we interact with. We see ourselves as founders. And I think that hopefully translates into a really strong working relationship with the teams that we ultimately engage with. But it's something that I don't think a lot of people think about. But we are a startup ourselves, founded in 2016, and that's definitely how we operate.
And if someone's listening to this, either today or they're listening to it, years after we record, and they're like, "This person's awesome," I want to share, I want to learn more about them, learn more about the firm. How can people learn about you online? Do you have a blog? Do you have a website, Twitter? How can people kind of get in touch or learn more about you or the firm?
Yeah, the best way is probably just to go to our website, urbaninnovationfund.com. And there's a link where you could sign up for more information from us, but also contact our firm. You can also reach out to me on Twitter. I definitely look at, and all of our team looks at all of our inbound messages. So, feel free to reach out.
It's actually, I want to finish with this question because on my other the founder podcast, everyone says like they're on Twitter, hit me up on Twitter, but I think like actually I haven't asked a VC before. You just mentioned like you're on Twitter, everyone's on Twitter. You didn't say hit me up on LinkedIn InMail. You said Twitter. What is it about Twitter that is makes you always on it? And what are your thoughts on founders kind of being on Twitter? Kind of in your view.
We also look at our LinkedIn messages. So, whatever works for you is fine by me. I would say Twitter just tends to be where more people are. And so that's usually what we lead with. But, for us, I think we try to prioritize all of the platforms. At the same time, we fund less than 0.5% of the companies that we see. So we may not respond to every deal that comes our way, but we definitely have seen it if you send it our way. I think Twitter is just a really effective way to evangelize your business. Going back to the Catch example, their CEO, Kristen, is just like an incredibly dynamic presence. And I think especially during COVID, when it's so hard to like get out and connect with customers, she and other founders in our portfolio have really been able to leverage platforms like Twitter to really raise their profile as executives, but also just like actually talk about the business and get in front of customers. So I think that can be a very effective tool. At the same time, I should probably like take more of my own medicine. I'm not super active on Twitter as a poster myself. I'm more of a consumer of content, and I know that's a real criticism of some venture capitalists, especially I think, and this is a generalization, but a lot of women venture capitalists have less of a presence on Twitter than some of their male counterparts. And so it's something I think about a lot, but I also like, that's just not our culture as a firm. We're not, I guess, super self-promotional, which maybe we should be more of. But I definitely think it's an effective tool for anyone, especially founders. And so we are always interested to check out when we're evaluating a company, what are their C-level people putting out there in the world on various platforms, Twitter and other platforms, LinkedIn, Facebook, et cetera.
Sweet. Well, I appreciate you kind of diving into those platforms, and I appreciate you coming onto the podcast. You're building an awesome firm. I'm really excited to see the future investments that you put out.
Thanks.
Best of luck building this into a world-class firm that lasts for decades and decades.
Oh, I appreciate that.